If you're 50 or older, and your W-2 Social Security wages from the same employer exceeded $150,000 last year. In the past, you could choose to make your catch-up contributions pre-tax to lower your tax bill. But starting the 1st of January 2026, that option is gone for high earners. Catch-up contributions must go Roth. A lot of people have no idea this change already went into effect. This video breaks down the most important retirement rule change for 2026, who it affects, how it works, and what you should do about it. Here's what we're covering today. 1. What is this new rule and who does it affect? 2. How do you know if you're a high earner? W-2 Box 3 is key. 3. What does this mean for your tax bill? 4. A decision framework. What you should actually do about it. What is this new rule? This rule comes from Section 603 of the Secure 2.0H Act, starting the 1st of January 2026. Employees with prior year W-2 Box 3 FICA wages from the same employer exceeding $150,000 who are 50 or older must make their catch-up contributions as Roth contributions. The rule is triggered when wages are greater than $150,000. Exactly $150,000 does not trigger the Roth requirement. Note: Secure 2.0H's initial threshold was $145,000, adjusted annually for inflation to $150,000 in 2026, and will continue to rise in future years. W-2 Box 3 FICA wages include salary, tips, bonuses, commissions, and taxable fringe benefits. In plain English, you can no longer choose pre-tax catch-up contributions. That money gets taxed in the year you contribute. Here's the key thing you need to understand. This rule only applies to catch-up contributions. That's the extra money you're allowed to put in once you hit 50 and over. Your regular deferral limit, the $24,500. That's completely untouched. You can still contribute that full amount pre-tax, just like before. Now, here's another important detail. This rule covers 401ks, 403bs, and governmental 457b plans. So if you're in any of those, pay attention. But if you have a traditional IRA or a Roth IRA, those catch-up contributions, the $1,100 for folks 50 and up, are completely exempt. This rule doesn't touch them at all. Who is not affected? This rule only applies if all three conditions are met. If anyone doesn't apply, you're not subject to the new rule. 1. You're 50 or older. 2. Your prior year W-2 Box 3 FICA wages from this employer were over $150,000. 3. You plan to make catch-up contributions this year. A lot of people ask, how do I know if my wages count? It all comes down to W-2 Box 3. The IRS rule is clear. The threshold is based on prior year W-2 Box 3 FICA out wages from the same employer. 3 key points. 1. Same employer only. If you work for multiple employers, each one looks at their own wages separately. Employer A going over only affects your catch-up with Employer A. It doesn't affect Employer B. Wages are not combined across employers. 2. The $150,000 threshold. For 2026, look at your 2025 W-2 Box 3 wages. Greater than $150,000 triggers the rule. Exactly $150,000 does not. 3. Investment income doesn't count. 1099 income, K-1 partnership income, stock gains, rental income, interest, none of these count. New hire exception. If you didn't have any FICA wages from this employer in the prior year, for example, you're a new hire in 2026. You're not subject to this rule for the current year. What does this mean for your tax bill? Let's run the numbers. Say you're 55, and your 2025 W-2 Box 3 wages were $180,000. In 2026, you want to contribute $8,000 in catch-up. The standard catch-up for 50 to 59 is $8,000. If you're 60 to 63, you can contribute up to $11,250. But that's also subject to the same Roth rule. Before 2026, you could contribute pre-tax. At a 24% marginal rate, you'd save about $1,920 in taxes that year. Starting in 2026, you must go Roth. That $8,000 gets taxed in the year you contribute, adding about $1,920 to your tax bill depending on your marginal rate. But here's the trade-off. Roth money comes out completely tax-free in retirement. So it's a choice between paying tax now or paying tax later. If your retirement plan doesn't offer Roth contributions and you meet the high earner threshold, you won't be able to make any catch-up contributions at all. Employers are not legally required to add Roth functionality, but without it, they effectively eliminate catch-up contributions for high-earning employees, which is why many companies are rushing to add Roth in 2026. Transition period note. The rule takes effect the 1st of January 2026. The IRS allows a good faith compliance standard for 2026. Most employers must complete plan document amendments by the 31st of December 2026. With final regulatory compliance fully effective starting in 2027, if you work for multiple employers, the rule applies per employer. Each one looks at your W-2 Box 3 wages separately. Example, you earn $160,000 at employer A and $140,000 at employer B. Your catch-up at employer A must go Roth. Your catch-up at employer B can still go pre-tax. Let's distinguish the two types of catch-up contributions for governmental 457B plans. 1. Standard age 50 plus catch-up, $8,000 per year. Subject to the new rule. High earners must go Roth. 2. Special 457B catch-up. 3 years before normal retirement age. This special catch-up is not subject to the Roth mandate. You can still contribute pre-tax. Alright, now let's get to the most important part. What does this rule actually mean for you? So, if this sounds like you, then you need to take action. You're 50 or older. Your 2025 W-2 Box 3 wages are over $150,000, and you're planning to make catch-up contributions in 2026. Here's what you gotta do. Check if your 401k plan offers Roth contributions. If it doesn't, you need to reach out to HR, because otherwise, you won't be able to make any catch-up contributions at all. Period. Now, on the flip side, if this sounds like you, don't sweat it. You're under 50. Your 2025 W-2 Box 3 wages are $150,000 or less. Or you're just not planning to make catch-up contributions. In that case, this rule doesn't really affect you. You're good to go. 3 action steps. Action 1. Confirm your plan offers Roth. If your plan doesn't offer Roth, and you meet the high earner threshold, you can't make catch-up contributions starting in 2026. Contact HR to confirm whether Roth has been added. Action 2. Plan your cash flow. Roth catch-ups mean you'll pay more tax this year. Set aside money for that extra tax bill so you're not caught off guard. Action 3. Consider Roth conversions. If you have a large pre-tax 401k balance and you're in a low tax window, you could consider gradually converting to Roth over multiple years. But keep in mind, conversion amounts count as taxable income. You need to evaluate potential bracket creep and IRMA Medicare surcharges. Here are the key takeaways for the 2026 mandatory Roth catch-up rule. First, who's affected? 50 or older. With prior year W-2 Box 3 wages from the same employer greater than $150,000. Second, only catch-ups are affected. Your regular $24,500 deferral can still go pre-tax. Third, check if your plan offers Roth. No Roth option means no catch-up contributions. Fourth, multiple employers are evaluated separately. Each employer looks at your W-2 Box 3 wages independently. Fifth, plan your cash flow. Roth catch-ups mean higher taxes this year. Sixth, governmental 405(7)(b) exception. Standard catch-ups are subject to the new rule, but the special 3-year pre-retirement catch-up can still go pre-tax. This rule directly impacts your tax bill, but knowing the rules ahead of time means you won't be caught off guard. I'm Gino. Next time, we're zooming out. Secure 2's big picture changes. Auto enrollment, student loan matching, emergency withdrawals. See you next time.